You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast. I want to start out today by reminding you of a couple things. First of all, wealthformula.com is a website that houses this podcast, and there is a ton of great resources on there that you really ought to consider checking out, including my free book, 7 Secrets of Eternal Wealth, which was an Amazon bestseller, and it can be yours simply by texting 44222 and typing Wealth Formula, but also, obviously, you can go to the website, wealthformula.com. You can also sign up for Investor Club at wealthformula.com. What is Investor Club? Well, we do a lot of financial education on this show. We talk about investments, etc., but we don't do any specific sort of, we don't go out there and solicit for investments and things like that. If you want to actually put some of these things to use and you are an accredited investor and you want to get off the sidelines, put lazy money to work, that's where the action happens. That's where the magic happens. It's in Investor Club. Go to wealthformula.com and simply click and the Investor Club tab and join us and get off the sidelines. That's the bottom line. Now let's talk a little bit about this week. Up to 10% for me of my liquid assets are in very risky stuff. Specifically for me, I have sort of, a lot of that 10% tied up in what are known as digital assets or cryptocurrency and other startups as well. Now, a lot of people think I'm being irresponsible, right? Particularly because I have this captive audience with whom I have influence, that when they hear me, that I am interested in this stuff, that I am involved with this stuff, that it may cause them to do the same. Now, if I was just shooting at the hip and telling you to put all your money into this stuff, I would understand that's not good advice. But even highly volatile investments, otherwise known sometimes to some people as gambling, may have their role in your portfolio. They may not, but they may. And to be clear, as you probably know, every year, most of my investments, the money I make goes directly into real estate. About 80% is allocated into real estate, 80% of my investable stuff every year. Okay. And specifically, 80% of that money goes into the opportunities that you see in what we called Investor Club, what we just talked about before. Now, there are many wealth advisors out there who would tell you that it is nuts to have too much money in real estate, right? I mean, that you should really have a substantial portfolio of stocks, bonds, and mutual funds. I mean, that's the safe stuff, right? That's not alternative, purple hair nose ring kind of investing like real estate. Really? Listen, ain't going to happen. I'm not going to buy for it. One of the great things about being financially literate and kind of, knowing the reality of everything is that you get to take an objective look at what's out there and you get to make your own decisions about your finances and make them guilt-free. You know what? You don't need someone with a 3-month-long accreditation course to tell you what makes sense. I mean, if you are going to take some time and you're a smart person and you're financially literate and you are the master of your own destiny, then why do you need these people to tell you what to do? Listen, in my case, my perspective is very much skewed too, I guess. In my opinion, residential real estate specifically isn't risky if you know what you're doing, or invest with someone who does, right? Like an operator that does. Why? Because, people have to live somewhere, regardless of what the Dow Jones Industrial Average shows you. Real estate, in my view, in the hands of people who know what they're doing is quite safe. My dad was an ambitious immigrant who back in the late 60s and early 70s came to this country as an engineer. Didn't know anything about real estate, but he kind of figured it out pretty quickly. He didn't quit. I think he got fired from his job because he got so interested in real estate. He was calling around, making real estate calls all the time. Anyway, his real estate investments over the last 50 years ultimately paid for my upper middle class upbringing and my education through medical school. So from my perspective, this stuff doesn't seem very risky. In fact, the only time my dad got in trouble was when he invested in the stock market. Why? Because he didn't really know what he was doing, and things just looked like it was going up and up. And boom, the .com, thing happened, and it was, he was blown to oblivion. And so, if he had a significant, if anybody who had a significant, part of their net worth invested in the market back in that era, it would have been a big mess, right? Now, but let's get back to this digital currency thing because, speaking of risk, it's not like the .com is risky and digital, .com era stocks were not, that they were risky and that digital currencies were not. In fact, there's a lot of parallels there. This digital currency, cryptocurrency stuff, it is seriously risky. Buying it is very risky. But you know what? On the other hand, a lot of people have gotten very, very wealthy off this stuff already. And, we're really still in early stages. So who knows what's going to happen? So let me ask you this, to determine whether or not this is even worth considering. Say you invested $20,000 into a variety of cryptocurrency projects and you lost it all. Would it kill you? That's the question. Would it kill you? Of course, you don't want to lose $20,000. Who wants to lose $20,000? Okay, now alternatively, say your $20,000 became $2 million. You say, no way, that's not going to happen. Well, it's happened multiple times in this space in cryptocurrencies. But say it did happen. Maybe it's not a high chance, but maybe it could happen. Is it worth it for you to at least have a chance of this happening in your lifetime, right? That's really, in my view, how you have to look at these things. I'm not saying invest in cryptocurrency. What I'm telling you is that there is a role for this thing called asymmetric risk for many of you. And that's the kind of analysis you need to do for yourself when considering investments of, this asymmetric risk profile variety. Like, you lose it, it's not a big deal. You win it, you have life-changing money. Now, chances are, if you're a follower of Wealth Formula podcasts, you're already doing fine. You don't have problems paying the bills. You're not stuck in a cubicle. You make great income, have all the basic things you need to live a happy life. But what if you had exposure to something that could put you in an entirely different league of wealth? Would it be worth putting a little capital at risk to make this happen? Well, listen, bottom line is, for me, it is very reasonable to do that. And that's why I invest specifically in cryptocurrency. This is not foolish like people say. Some people say it's crazy. It's, whatever. It's rat poison, etc. This is calculated risk. That's what it is. It's a kind of risk that the wealthy take all the time. If you're making, tens of millions of dollars, would it hurt you to, put like $500,000 in something ultra, risky and turn into a billionaire from there? That's what these people do. That's what the Winklevoss twins did, by the way. The Tyler and what's his twin brother's names? The guys who sued Mark Zuckerberg because they say he stole their idea at Harvard and went on and made, billions of dollars. Well, these guys, that's how they got into Bitcoin in the first place, right? They sued Mark Zuckerberg. They ended up getting a decent chunk of some kind of settlement from Facebook, and they dumped a decent chunk of it into buying Bitcoin, when Bitcoin was under $1,000, well under 1,000. I think it was a couple $100, and they turned, I think what ended up being like, a couple $1,000,000 into $1 billion. That's how they did it. So I'm not making this stuff up. It happens. And so asymmetric risk is something that the wealthy do. And it's not just the wealthy, it's the endowments. I mean, look at even recently, Yale and Stanford, some of these really, really well-known endowments have gotten exposure to the space. Now, not a lot. Again, they're taking small parts of these huge endowments and creating exposure for themselves into digital assets. And why would they do that? Because they don't want to miss out. And why should you do that now of all time, right? I mean, listen, part of it is that no one's talking about it, right? In the bull market of 2017, everyone and their mother was talking about Bitcoin and cryptocurrency. You couldn't go to your barber. Your barber owned Bitcoin, right? And then 2 years later, now the technology's better. Institutional money's kind of getting in. You've got these institutional infrastructure and on-ramps into digital currencies. But individual investors don't seem really that interested right now. And that's exactly why it's probably the time, if you haven't, to potentially put your toes in this area in digital assets. If it's something you might want to do. Now, the more you read about this stuff, the more exciting it will seem to you. So don't get carried away. But again, if it's beer money, and then who cares, right? I mean, that's really what it's all about. Now, to help you understand what's going on in cryptocurrency and whether you should consider getting into the game, I invited Teeka Tiwari back to the show. Teeka, as you know, is an ex-Wall Street guy, a hedge fund guy, and he was one of the youngest VPs in Shearson Lehman history. Very, very smart and accomplished investor who specializes in asymmetric risk. He's also incredibly good at explaining this stuff. So when we come back, Teeka Tiwari. Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is no stranger to the show. He's a guy who grew up in foster care and came over to the U.S. at the age of 16 with just $150 in his pocket and the clothes on his back. And then by the age of 18, becomes the youngest employee at Lehman Brothers. By 20, he becomes the youngest vice president in Shearson Lehman history. Later in his career, he goes on to launch a successful hedge fund and live the Wall Street dream. I mean, he's known on Wall Street as the guy who's made a fortune on what is known as asymmetric risk, which we're going to talk about quite a bit. And for the rest of us, for many of us, that is, he is best known for being the editor of the Palm Beach Confidential newsletter, which focuses on digital currencies. And I am a subscriber to this, by the way. Teeka, welcome back to Wealth Formula Podcast. Teeka Tiwari.
Thanks, Buck. It's a pleasure to be here, and thank you for having me.
Yeah. So, you were on not too long ago, and some people are listening to this stuff about cannabis, and they're probably thinking to themselves, well, why is this guy talking about cannabis and digital currencies? Like, what is his specialty? In fact, the way I'm thinking about this, there's one main thing that they have in common. They're both in this area that you call, and we call, asymmetric risk, which is really your thing. Discuss what that means, and if you would, how have you applied it to your own sort of growth and ultimately to your own wealth.
So before I get into asymmetric risk, I want to talk about how I discovered asymmetric risk and how I changed the way that I invest. So when I was in my 20s, I developed a lot of wealth by taking massive risk in the stock, options, and commodities market. And I would bet huge positions. And then that all came to an end in the late 90s when I was on the wrong side of a series of trades that were triggered by the Asian financial crisis, which ultimately compelled me to file for bankruptcy. And so I had lost about 10 years of wealth creation, which was considerable at the time. And what I learned was that I had to change my approach, that I couldn't bet it all every single time. Otherwise, I would never get off this boom and bust merry-go-round. So what I realized is that I would build a portfolio of somewhat safer, more income-oriented investments, and then I would focus on these ideas that are called asymmetric risk trades. So what's an asymmetric risk trade? An asymmetric risk trade is where you can take a relatively trivial sum of money, and if the idea doesn't work out, it doesn't impact your net worth or your day-to-day lifestyle in any way, shape, or form. But the asymmetric part of it is that if it does work out, it can absolutely move the needle on your net worth. So an example of that would be something like NEO, which I recommended at around 12 cents, that ended up going up to about $161. So that's something that you could have put $1,000 in and turned it into over $1 million. So that's a classic asymmetric trade. So what I tell my readers is you can't build your whole portfolio around high risk asymmetric trades. But if you take, let's say, 5 to 10% of your liquid net worth and allocate it to these types of situations and one of the things I talk about is using uniform position sizing. What you put yourself in the position to do is absolutely grow your net worth, sometimes 3, 4, 5, 6x, without putting your current lifestyle at risk. And it is a sweet spot of wealth creation that I've created and popularized now for several years that has not only transformed my financial life, but the financial life of many of my readers.
So as you know, Teeka, my group, the Wealth Formula Group in general, I mean, there's a lot of people who are well-to-do. They're, accredited investors. They have, typically probably more money to invest than others. They're, and I say this because there is a little bit of a difference there when it comes to somebody who's barely getting by living check to check, that there is an opportunity in your portfolio to say, okay, what percentage of this portfolio could I put in that, I mean, listen, if I lose it, no big deal. I mean, I won't be happy about it, but it won't hurt me that much. On the other hand, this could explode. Now, when you look at it from the perspective of somebody who's got a fair amount of money and like who's investing, several $100,000 a year, maybe $1 million a year, something like that, like, what do you think is a reasonable amount of a portfolio? Like, I know, for example, that even universities are getting into this and they're looking at, hey, maybe, 1/2 of 1% or something like that. Mm-hmm. I mean, I know you're not in the business of giving financial advice, but I'm just curious kind of what your approach would be in terms of allocation.
So again, generally speaking, I would say 5 to 10% of your liquid net worth. So let's say you've got a business that kicks out $1 million a year that you have to allocate for your investments. $50,000 to $100,000. Right. It definitely, nobody likes to lose $50,000 or $100,000, but it's not going to have a material impact on your lifestyle. But if you invest $50,000 to $100,000 and these asymmetric bets pay off, you're talking about $5, $6, $7, $8, $10, $12 million in returns on what is a relatively tiny investment relative to your net worth, and that is the beauty of this approach.
Yeah, and I'm glad you said that, because that's exactly kind of where I'm at, sort of lingering between 5 and 10%. And for me, I kind of put this in there about, I kind of put this in that area with startups, right? I'm not gonna have a separate category just for digital currencies, but anything that is super high risk, high reward, and I'm sitting at about 5 or 10%. Now,
that all goes into the same bucket. So I just want to be clear that for everybody, it's not just, this is cryptocurrency is 5 to 10% and startups is 5 to 10%.
Yeah, that's right.
No, they all go into the same bucket as asymmetric risk.
Yep. Now, okay. So we kind of got ahead of ourselves, and, you haven't been on the show talking about cryptocurrency in a fair amount of time. We have a lot more new listeners now. So for those who know very little about cryptocurrency, but they're smart, they're sophisticated, say they're a group of, high net worth investors, you're talking to you, they've not heard about this. How do you explain this in the most efficient way possible, and what the significance of it is?
Okay. So that's a really big question.
Yeah, no, I know. But I bet you've answered it a few times.
But I'm going to take a shot at. So listen, as a wealthy investor myself, why would I want to bother with cryptocurrency? I'm already rich. Why do I want to mess around with this? So I'm going to answer it from that perspective, right?
Yeah.
One, it's always nice to make more money. But two, the bigger reason is what I want people to understand, especially wealthy investors, is that it's very rare to invest at the beginning of a brand new asset class. Very, very rare. Brand new asset classes just don't come about. Digital currency is a brand new asset class that has legs. So why does it have legs? It has legs because we have never had an asset class that is completely non-correlated with the business cycle. It's never existed before. Every asset class in the world is somehow tied to the business cycle. Gold, industrial metals, currencies, stocks, bonds, they're all tied to the business cycle in one way, shape, or form. Things like Bitcoin are not. So why does that make it valuable? It makes it valuable because if you are a pension fund, you are allocating capital across traditional and non-traditional assets, you still have this problem of deep correlation, right? The business cycle falls apart and you're taking hits across the board. So there have been studies that have shown just with a small allocation of Bitcoin, anywhere from 1% to 5% across the portfolio, even though Bitcoin is wildly volatile, because it is not correlated and not tied to the business cycle, it actually reduces your overall volatility and your overall risk in your portfolio. And that is incredibly valuable. So just from a high level portfolio construction standpoint, you will see the world's hedge funds, pension funds, massive allocators of capital start to move tiny slivers of their money into things like Bitcoin. And we're talking tiny slivers of an $80 trillion pie, right?
Right.
In real terms, it's enormous money. In relative terms, relative to what they have under management, it's a small amount. But when you're coming off a base where the whole market's only worth 300 billion, it doesn't take much to move the market. So that's from the high level. That's absolutely why you must have some cryptocurrency. And then the next level beyond that is that mankind has never had an asset. There's never been an asset where a stronger man couldn't take it from a weaker man. So whether it was the caveman knocking one guy over the head for his shells, or the government coming in Venezuela and confiscating money, or the Argentinian government saying, oh, we're having a holiday and taking all your assets from the bank, something Brazil has done on multiple occasions. The everyday person has not had this ability to hold an asset that has been beyond the confiscation ability of a government. So something like Bitcoin and digital currency, if you are smart in how you buy it, if you don't talk about it, you buy it quietly and you store it appropriately, it is absolutely impossible, short of somebody literally putting a gun next to your head, for them to take that asset from you. And that is remarkable, because even if you've got $1 million in gold and you somehow manage to hide it, how are you going to travel the world with $1 million in gold? How are you going to spend $1 million in gold? You're just going to go to the store and break a piece off with a piece of pliers? You just can't do that. The beauty of digital currency is you can walk around with a thumb drive that big with $1 billion in it and nobody knows. And let's say, hey, I don't want to keep $1 billion in Bitcoin. I want to do it in a stable coin. Fine, put it in a stable coin. But this idea, this portability of money and this complete ownership of an asset that nobody else has any ability to take from you, that is valuable. That is incredibly valuable.
So let me ask you what may seem like a very basic, simple question, but I think it's worth asking. So why is it so volatile? Why is Bitcoin and Ethereum, for example, why these are the major, the two biggest by market cap? Why are they so volatile? And to the extent that they are uncorrelated, do you see that as a function of the size of the market cap, or is it something else inherent about digital currencies that makes it this volatile?
I think it's both. One, they're relatively small. So if, for instance, if you look at Microsoft in its early days, it was a crazy volatile stock. Yeah. Up 40%, down 40%, down 30%, going through bear markets that lasted 2 years, wrecking billions of dollars in value. You look at the early days of Microsoft from the 80s into the mid-90s, the stock was all over the place. And then as the stock got bigger and more mature, of course, volatility tamped down. So you'll see that. So what I say with volatility is that welcome that volatility. Without it, the opportunity to make enormous amounts of money off a small amount of money won't exist. At some point, Bitcoin and Ethereum will move to this more blue chip status where maybe you make 8% a year or 6% a year or something, or something like that. Thank goodness we're not there yet. The other side of it is that there, the markets that are built around trading these are completely unregulated. They're wild. Right? You don't, and there's all types of crazy manipulation that goes on in the market. You have some Bitcoin whale, let's sell 1,000 coins and scare the market down, and then let's go buy back 2,000 coins. It's the Wild West. And somebody, a skeptic might say, well, why do I want to buy now? Why don't I buy when the market calms down? Because when you buy when the market calms down and it's moved to this very highly regulated, very low volatility asset, it could have 10x'd between now and then, right? So yes, there is volatility, but I believe if you position size rationally, you will be well rewarded for that volatility and that uncertainty.
So admittedly, I was skeptical of cryptocurrency early on, and I finally did get in, and my timing was actually really good. It was early fall 2017. Right before a massive bull run. And that, of course, was followed by what has been called crypto winter. So the question is winter over? Because it sure seems like it's an awful long thawing period. I mean, we seem like to have gotten there, but there's a stall. Is it over, or do you still see some rocky shores ahead before there's a big move potentially to all-time highs?
Well, no, crypto winter was over in April, and I put out a report talking about that, and I pinpointed when that happened. It happened when Bitcoin broke its downtrend line. So if you go back and if you look at each of the so-called crypto winters or horrible bear markets that have been in the space, Bitcoin will always lead the market first, always. And then the altcoins play catch up, right? So it feels worse than it is right now because the altcoins got crushed and many of them have stayed crushed. They haven't come back. And people, it's probably the most popular question I get. Okay, Bitcoin's up and it's been up as much as 400% this year, but why aren't the altcoins moving? And my answer is because it's not yet time. If you look back at the data, generally there is at least a 6-month time lag between the time Bitcoin breaks its downtrend line and the time that the altcoins move higher. So that next stage we'll be entering to in about October, and you'll see a percolation in the altcoins, and they'll start playing catch up.
Does that also correlate, Teeka, with Bitcoin, like an all-time high for Bitcoin, though? I mean, obviously Bitcoin has recovered substantially. We're like 300-400% up from where we were when Bitcoin was at 3,000.
Yeah.
But the question I have is, and I have not looked at this history closely. Even though there's this recovery, do you have to start approaching all-time highs for those alts to really make their move? Is that what you've seen historically?
No, you don't. If I look back at when the alts started playing catch up in 2016, Bitcoin was starting to move higher, and then going into 2017, and then the alts really didn't start kicking in until around May. And that's when they started moving, and eventually the alts outpaced the type of action that was going on with Bitcoin. So if we look back at how the altcoins move, generally what happens is you have a new series of buyers that come into the market, and they're all centered around Bitcoin. And that's happening right now. Kelly Loeffler just announced from Bakkt that they're going to have physically backed futures have been approved September 23rd. I believe is the date that they're actually going to start trading. So this brings in a whole new group of traders, a whole new group of investors. And then so they start getting their feet with Bitcoin, and all of a sudden they might not even know anything about altcoins, Buck. That's the thing, right? For a lot of people out there, to them, when they think digital currency, the only thing they really think of is Bitcoin. So as they come in,
altcoins are just anything that's not Bitcoin. For anybody who's curious, what we keep talking about. So anything Ethereum, any other token that's not Bitcoin generally is called an altcoin.
Right. So as they come in, they start getting exposed to these other coins, and then they start playing with them, and then they start investing in them, they start trading with them, and all of a sudden people look at Bitcoin, and they look at something else that's a little bit smaller, and they say, okay, let's play around here. And then you start seeing this broadening of the rally.
So
that brings in more buyers.
That this time around, though, specifically, I know your part of your thesis is that this time around may be different because, bigger money, institutional money. But one of the things that we've really looked at, or you've looked at and talked about, is, one of the limitations to big money coming into this stuff is custodianship. And but the altcoins, a lot of the altcoins, most of them are not going to have that kind of infrastructure. So does that? Just playing devil's advocate, does that then say, well, they may just stick to whatever they can buy on Coinbase and or on Bakkt?
Well, these coins, most of the altcoins are ERC20 coins. So in terms of having the infrastructure, as long as you can support ERC20, you can support hundreds of coins that currently trade. And so if you look at what Bakkt is doing, they're going to be supporting Bitcoin first, and then they're going to be supporting Ethereum. So if they support Ethereum, they will naturally support every other ERC20 that's out there. And remember, companies like Bakkt are in the business of incentivizing trading because they get paid for everything that goes through their network. Right. So it would be odd to imagine that they're only going to limit their entire business model to just the trading of Bitcoin. It doesn't make any sense. If you look at what they've done in the securities market, they haven't just limited themselves to the trading of the S&P 500. They trade everything. So I do think that liquidity will trickle down into the whole market. And of course, the ERC20 coins, I think, will be the first to get the most amount of liquidity because it will be the easiest to support from a back-end technology standpoint. The other thing I want to mention is that another driver of the altcoins will be what I believe will be a proliferation of securitization products. So ETFs, different types of futures. I see a world, I've got to believe within the next 12 months, we will see an ETF that will give us the ability to own 20, 30, 40, maybe 50 coins in one ETF that trades, or one type of security that trades. Maybe it's a coin put out by Bakkt and says, okay, you buy this coin and you've got the top 100 altcoins, exposure to the top 100 altcoins. Right.
And then, I know a lot of people you talk about the ETF for Bitcoin, and this has been sort of bounced back by the, or delayed by the SEC several times. Do you really think of that as a big deal compared to some of the other movements that you mentioned Bakkt, and I think there's LedgerX, things like that that are allowing for institutional buyers to participate? Does an ETF really make much of a difference in your view?
I think an ETF is important, but I think the SEC is becoming less important in that process, and I'll tell you why. Several very large brokerage firms, from Fidelity to E-Trade to TD Ameritrade, have announced that they want to offer Bitcoin trading to their users. So I'm talking about a system where you can log in, click on a button on your Fidelity account, and you can start trading Bitcoin the way you would the S&P 500. Once that comes out, let's assume it comes out this year, which they've talked about that they want to do it this year, but we'll see. Everything seems to run a little slower than people think. But if that comes out this year, and something like 15 to 20 million people can now trade Bitcoin directly from their brokerage accounts, to me, it makes an ETF a foregone conclusion, because the SEC has no reason now to stand in the way of it. And that's what I think that they're waiting for, Buck. The SEC is not known for blazing a trail. Mm-hmm. The SEC is not known for moving ahead of the market. So if they can look and say, well, Fidelity's offering it, TD Ameritrade is offering it, Schwab is offering it, our ass is covered if we approve an ETF. Yeah. I think it's really a CYA problem with the SEC. They don't want to be the first to make this move. And let's say there's a problem with it and everybody blames the SEC.
You know, there is this product that I know of. Maybe you could talk about this because, you know, in the context of an ETF and being able to buy Bitcoin easily, you know, I look at there's a Grayscale Bitcoin Trust, GBTC, which is publicly traded. I mean, what's the difference? What am I missing there? I mean,
well, that's a closed-end fund that has limited liquidity, and it can sometimes trade at 100% premium.
Yeah. Okay.
Got it. Bitcoin. Yeah.
Okay. So lots of things happening in the space, as you mentioned, and one of the things that I think that you said that it seems very clearly true, whether or not whether or not you believe there's going to be another bull market, is there's a ton of technology improvements and infrastructure and all these things that are going on, and price a lot more, by the way, than back in 2017 when there was when prices were off the charts. Mm-hmm. So within that context, what are, say the one or two things that are you most excited about in the space that gives you the greatest confidence that this is the new, the new .com era, I guess, after the rubbles fell, as you mentioned before, offline, and, the rise of the Amazons and the Apples in the crypto world?
I'll tell you why. It's because I'm finally seeing major corporations, real corporations, doing partnerships with crypto companies, not memorandums of understandings, not MOUs. MOUs are meaningless, but real partnerships where they're actually using the technology. This is stuff I talked about a year ago, 18 and a half months ago. I said, look, real companies are going to start coming into the space. They're going to start partnering with some of these companies and start using the technology. And it's happening. I'm seeing real businesses like Barclays put up their own money to back certain platforms. Like, for instance, with trade finance. BMW putting up their own money for back-end logistics. So this is a huge shift in the type of person that is getting involved in the marketplace. I'm seeing massive credit card processors get involved with tiny startups because they want to piggyback what's going on and the markets that they're opening up with their applications. So this, to me, Buck, is such a difference maker, right? Like if we came into 2019 and none of these deals were happening, I would say I would be on here and I would say, Buck, you know what? The cake just isn't baked yet, man. We probably got to wait another year. But when I start seeing very large, very smart corporate players making strategic moves to align themselves to certain projects, you can't ignore that. That's just something you can't ignore. And so this is what has me incredibly excited for this next phase that I see taking place in crypto.
One of the things you mentioned earlier, and you've mentioned in the past, which I agree with, generally speaking, is that some level of regulation is a good thing so that it becomes less of a manipulated market. So it becomes something that, larger, big money investors and institutional investors take an interest in because they don't want to be in something that's, that's not legit. There is a negative a little bit to that, in that some of the opportunities out there are, starting to get restricted in terms of American investors. One of the examples I can think of, to me, is one of the biggest things is Binance, which is the number one trading platform in the world, is now effectively saying U.S. investors, we'll see you later. We're going to build something sometime, and we're going to call it, Binance US, and we're going to have a lot fewer tokens there. What concerns me as an investor in some of the various digital currencies at that point is, well, how does that affect my liquidity as a US investor? And I'm wondering how it is affecting your portfolio.
Okay, so there's a couple of things around that, and I can't advise people to do this. I can only report on what some people are doing to get around this geofencing. Is they're using virtual private networks.
Right.
And so through the use of a virtual private network, they can get access to any exchange in the world, so long as they're using a VPN that mimics a country that this exchange is allowed to operate in. So as far as I know, Binance is not doing anything to prevent anybody from using a VPN. So that's, just want to get that out there. Again, I can't.
Look, just to interrupt there. I mean, that in itself is a little tricky, though, right? I mean, isn't it? Because then you've got to deal with U.S. taxes and all that. If you're dealing,
you always have to deal with U.S. taxes, no matter what, whether you're using a VPN or not.
So it wouldn't be illegal technically to use a virtual private client, a virtual private network, and use Binance. Yeah.
For you, for me as an individual, would I be breaking any laws?
Yeah,
I don't think so. But I'm not an attorney.
Right.
Binance might be breaking some laws.
Sure.
But I don't think that I would be. But again, this is something everybody has to make their own decision. Yeah. But the other side of this is that Binance is putting together their own DEX, which is a decentralized exchange, which will allow for peer-to-peer trading. And I think you'll see more of these types of decentralized exchanges, which I'm a big fan of. I hate the idea of centralized exchanges anyway. So there are some speed problems with decentralized exchanges, but they're getting ironed out. And I think in the future, a lot of trading is going to move to peer-to-peer. But you're right, it's certainly a concern. For now, I would say the biggest solution that I have read about, and again, I can't formally tell people to do this, is to use a virtual private network.
The other question, though, I think is just as a follow-up on that, Teeka, is that, okay, so say you use a VPN, but not everybody's going to do that. Probably most people aren't going to do that. Then there's an issues just in terms of liquidity, right? Or don't you think that's a problem anymore?
No, I do think it's a problem, but I also rely on the greed factor of the participants in this market. Right. That they will figure out a solution, because there's too much money to be made for liquidity that wants to come into the market. Somebody will find a way to bring that liquidity into the market.
Okay. So anyway, so like I believe that Bitcoin bull run is inevitable. What do you think, if anything, what are you looking for that might trigger? And I know you're saying already that we're kind of in a bull market already, but what triggers that sort of next level all-time high thing? Is there anything, or do you think this is something that's going to be more of a gradual rise, more organic than it was in 2017?
Well, there are several things which I'm going to be talking about specifically. I don't really want to spill the beans on that here, but I have an event coming up, which I want to talk in more detail about, a very specific event that I think will act as a massive catalyst.
Right.
Outside of that, I think this whole idea of, I call it this kind of new narrative, right, among institutions, where before 2 years ago, 3 years ago, they looked at Bitcoin and they said, oh my gosh, Bitcoin, that's for gun runners and pornographers. We have no interest in Bitcoin. And now they're starting to see Bitcoin as a way to eliminate this correlation risk in their portfolio. So I think that narrative will gain more ground. In fact, I've been invited to a conference in San Moritz with 500 top-tier investors, and I will be putting forward that research that I've drawn together to that audience and really helping propagate that narrative, because it is transformational. If you manage a large pool of capital, what you can do with your overall volatility and how you can adjust it lower through just a tiny amount of Bitcoin is absolutely remarkable. So I think that's more of a slow burn, Buck.
Sure.
But as that gains speed, I mean, can you just imagine just the amount of buying if pension funds say, okay, going forward, 0.5% of all our assets are going to be in digital currency.
Yeah. I mean, and part of understanding that for people is to understand one of the great things about Bitcoin in particular is that this is an asset that is fixed to a certain number of Bitcoin that'll ever be created. So, we've never really had that kind of monetary thing before. I mean, to a certain extent, gold is that way, of course, but even, gold, there's always more gold every year, a little bit more gold. This is a truly deflationary asset that really where, you put more money in the pot, each one of those Bitcoins is going to be worth a lot more. And I can't think of anything else that's out there like that.
I agree.
I know you've got, the Palm Beach Confidential newsletter, Teeka. I just have to compliment you because I have been a reader for a couple of years. It is one of the most comprehensive and thoughtful investment newsletters I've ever subscribed to. I mean, it is totally the real deal. And I appreciate that. And one of the things that people can't join anytime. It opens and closes. And I know that it is going to be opening up and you're going to do a webinar coming up on that. But can you talk a little bit about the newsletter and the event that's coming up?
Yeah, sure. So in the newsletter, what I do is I will typically find one idea each month and give you a complete breakdown on the idea. And what I try to do, I understand not everybody is a cryptocurrency enthusiast or a cryptocurrency investor. And so what I try to do is write in a way that is easy to digest, easy to understand, not simplistic, but very easy for the layperson to get their head around and to really understand the concept that we're talking about. And I have not opened up Palm Beach Confidential for any new members for this whole year. This is the first time that I've done that. So, and the reason is I only open up Palm Beach Confidential to new members when there's an event that I think can have a massive impact on the broad market. So on September 18th at 8 p.m., I'm going to talk about one of these events. And the last time this event took place, you could literally take $500 and turn it into $5 million. Right? There's only a few times in the history of crypto where you have those types of windows of opportunity. And so one of those windows of opportunity is about to open. And so at this event, I'm going to explain what it is, why it works, and why it will absolutely happen. This particular event will absolutely happen. There's nothing that can stop the event from taking place. And so I'm going to share my 5 top coins, one of which I'll give away for free during the webinar, that I think have that ability to go from $500 literally into $5 million. So it's an exciting time, and I'm really kind of chomping at the bit to kind of get in front of everybody and talk about this research that I've discovered.
One last thing I want to point out is I get, when we talk like this, sometimes people get really skeptical. They're like, yeah, that sounds a little salesy, Buck. That's not really kind of the usual thing that you're talking about. And I get it. Right. But the reality is this is a situation. This isn't, there are real people out there. There are kids out there who've become multimillionaires by doing exactly this. And so it's real. That's why I'm interested. That's why Teeka's
real. I mean, in my own investing, I've seen $1,000 investment go to as much as $1.6 million.
Right.
Okay. So it's real. The other thing I want to convey to everybody, I don't have to write newsletters anymore. I don't have to come on podcasts. I can sit on a beach all I want. Okay. So why do I do this? I do this because moving the needle on somebody's net worth, maybe not this audience, maybe my broader audience, it's incredibly gratifying, right? Helping people change their lives without putting their current lifestyle at risk. If that's my one legacy in this life, could you ask for anything more, Buck? Really, it's incredibly gratifying to be able to do that. And we have this opportunity now, but this opportunity won't last forever. At some point, this will be a multi-trillion-dollar asset class, and the ability to make gains like that just won't exist.
Teeka, as always, it's been a pleasure talking to you, and thanks again for being in Wealth Formula Podcast.
Thank you, Buck.
We'll be right back. Welcome back to the show, everyone. Hopefully you kind of understand why I still think this is something that people ought to be thinking about. If you're, if you don't have exposure, just a few $100 even. What's the downside, right? It could be an opportunity to make a lot of money. On the other hand, if you lose it, it's not the end of the world. Skip a few cases of beer or something like that every month and do this instead. Listen, this week, you will be getting some emails from me, again, promoting Teeka's newsletter, which, as I said, I have been a subscriber to for a couple years, and I think it's a really great newsletter. I will say, I don't follow everything that Teeka says or advises, and I also have some differences of opinions, but I think it's a tremendous resource for information. And I think if you're not into this space yourself, I think his recommendations could put you in a really good position in the event of a, hockey stick or parabolic event or whatever you want to call it. But so I'm going to send you these emails from Teeka. You're going to get them this week. You probably already got one by now, that are urging you to sign up for his upcoming webinar. Watch the webinar, okay? Now, I will say this, that the emails you're going to get, they're very cheesy, right? They will provide good information, but they're sales copy. They're selling you newsletters. Now, as you know, I don't generally like this stuff, but I do like Teeka. I do like Teeka Tiwari. I know him. And so, the reality is that the copy is typically written by people at Palm Beach, this company that, it's a newsletter company. And so it's not really stuff that's coming from Teeka per se. So, Teeka's not going to write the sales copy. But the point of all of what I'm trying to tell you is that try to look through the cheesy sales copy. Don't say, hey, Buck, why are you sending me this cheesy sales copy? Sign up for the webinar and watch it. I think it's worth it. And if asymmetric risk investing in cryptocurrency sounds interesting to you, then you're definitely going to want to consider being part of that newsletter. Anyway, I'm telling you now so you don't email me again and tell me that the copy is cheesy. I know it is. Frankly, so does Teeka. He doesn't write it, but he is one hell of an analyst and has made a lot of people a lot of money. So that's it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.